Good morning and welcome to the Saxo Bank Morning Call. It is Wednesday, March 6th, 2019, and we have a very boring session yesterday for you in equity markets. A bit interesting, as we talked about at the top of the week. We saw that pretty big expansion in volatility. The trading range on Monday was quite big, and some would argue, we can look at the chart here, we have that spinning top or hanging man formation, whatever you wanted to call it, on the candlestick on Monday, the session before yesterday's. The one thing I would note is that we are seeing momentum coming off. We've seen this spectacular recovery into the, to start the year after that huge December low, and it just feels like we're running out of steam a bit. Whether this means that we're going to necessarily test the lows, which are so far away now, that's waxing awfully pessimistic, but at least momentum coming out here a bit. And I think one of the arguments could be that the market could get a bit uncomfortable with how much accommodation is coming from central banks, most notably the Fed. As we saw yesterday in an ISM print that was very strong, the ISM non-manufacturing out at 59.7. That's historically a very high reading. You can look here at the distribution of readings over the last 20 plus years. A lower print was expected than that, although not as low as January. Anyway, we've bounced back. You could argue, hey, looking back at 2006 and 7, we saw a long slide in the services sector before we actually started to see it, the economy hurting and the yield curve turning around. The red line here is the yield curve slope. We can still see we're in a flattening phase. But if you look back at 2000 to 2001, it was almost an instantaneous turnaround for both. So I think you can argue that history doesn't necessarily repeat, or you have to argue which episode repeats. In any case, we don't have the active evidence that we're seeing, weakening across the board, at least in the U.S. with a services print like that. The new orders was something like 65 plus for February, so this is a very strong print to say the least. Now, what was less positive overnight was the Australian GDP print, only at 0.2% quarter on quarter. A double that was expected. We're seeing a pretty strong reaction in the Australian yield curve. I've got the little inset to the lower right there on the chart, showing the degree to which the 2-year swaps have come off in yield, almost touching the lows. The larger chart there is the Aussie dollar. Pretty mild reaction. We still have the RBA's low out in the speech again overnight, talking up his optimism on the economy, and they've insisted as recently as this Tuesday's RBA statement that they're looking for this 3% growth target, not a target, but expecting 3% growth this year, and this optimism maybe keeping the Aussie in the range, as well as the Chinese insistence on maintaining that peg or maintaining that floor for the CNY. Finally, on currencies, the euro dollar looking at 113 again. I've got a chart here. It's just technically, obviously, a very important level. We've crisscrossed this level so many times since that first touch around late October last year. Looking at the ECB, of course, tomorrow, and wondering what the ECB could possibly say to support the euro, given that we're all expecting or questioning simply the timing of when they're going to move towards more accommodation. Let's take the discussion elsewhere. Let's look at commodities. Ola, we're almost recovering, at least in you have the strong focus, and you put out some great charts on these weekly positioning reports in the U.S. From the CFTC. We're almost live, or we're almost back to where we're supposed to be after the government shutdown.
Yes, it's phenomenal that we had a government shutdown between December and January, and only now the CFTC is catching up with reporting the weekly reports. But the latest table for commodities, which I can show you here, is covering the week to February 26th. So we're just 1 week out now. And what basically springs to the eye there is the continued build up in longs across the energy space. We saw platinum.
That's
copper.
What you've highlighted. The boxes you've highlighted.
Yeah, the box I highlighted at the top there. The net change. Also, we saw quite a big net change in both platinum and copper, which coincide with the break higher we saw in both of these contracts. So both of these are now back into a net long for the first time in quite a while. And then the grain space or the agriculture space is just a lot of misery there. We got red net short position almost across the board. And one of those maybe we should highlight is something like cotton at the bottom there, 21,000 lots. It's a 12-year high in terms of shorts. And if you look at the charts, I haven't brought it with me today, but just keep an eye on 75. If you start to make it above there, I think we could see some short covering. But just adding the next report, which will be out this Friday, is basically covering data up until yesterday, Tuesday. So we will be live from the following weekend.
Good stuff. And one thing I found a bit curious, I don't want to put you on the spot here, but the gold positioning was not all that stretched on the long side. It looked like it was around 60% of whatever the max long positioning has been in gold, so maybe not as much participation as one might have expected given the pretty decent rally we saw.
No, and what we saw the last week, if we return to the table, we can see there was a small reduction in the net. Gold is, you can see that they're close to the top. There's a small reduction in the net, but as John mentioned, the net 104,000 lots compared with the recent high of 173 is not that great. What has to be mentioned there, just a week up until the failed attempt to break 1350, there was a 69% jump in the net long. So a lot of specs got caught out in that move, or the failed move to break 1350, and that would probably have helped extend the aggressiveness in the rally or the sell-off we saw afterwards. So, but yes, the net long is relatively subdued here. We are facing some pretty tough battle here. 1275 on the chart. We need to hold that. If not, then we could see some additional long liquidation. So what we need to see right now is either the dollar turn around, which you're not in favor of in the short term. We need to see stock market start to capitulate. Again, potentially could happen, but we need to see some outside forces start to come in to support the market here.
Now, oil, we've got key DOE, the weekly report out from the U.S. What's going on in oil? I mean, it just seems like we're triangulating in a very small, narrow range here.
Yeah, the oil market, the report has become more and more volatile and unpredictable because we have these increased amount of exports out of the US, and we also right now have imports slowing both from Venezuela and from Saudi Arabia. If you look at the table I brought with you here, you can see that the predictions ahead of today's report, it's basically looking for quite a sizable jump in inventories. So you can see API last night reported 77.3 million barrel built, while the surveys ahead of the EIA is looking for 1.5. But what really shook the market last week was the bottom left chart, which is the crude oil net import into the US. It slumped to a multi-decade low, and that helped bring down the inventories. So really, that's probably the number we should look out for today. And remember, one of these super tankers these days, they carry between 1 and 2 million barrels. So it's just one that gets registered in the following week, and you can have quite sizable change in the import numbers.
Okay. Now on grains, not a lot to report. I noticed on at least one of the wheat contracts showing 100% short relative to the 1-year average. Looks like from these charts you can see why the sentiment's depressed.
Yeah, we don't discuss the grain market that often. There hasn't really been a lot to say apart from news has predominantly been negative. You can see the wheat broke the uptrend a few weeks ago and has continued down. We did see a little bit light of the end of the tunnel yesterday. US wheat has now reached price levels where they can start to compete. And that's really the key right now, that there is so much wheat across the world, so whoever's got the cheapest price obviously get the tenders, and we did see some signs of that. So potentially this 450 level in wheat could be a line in the sand here in the short term. But at the same time, both the EU, Australia, and Russia were out yesterday, basically looking for a big notch up in 2019 production. So that's not helping. And then on the right there, you got soybeans. We've been in an upward trend since news about trade starting to turn more favorably, but we still really need to see the outcome. And again, we got a bumper crop coming from South America, so the upside potential there right now seems to be limited.
Yeah, not a very exciting chart, at least for the bulls on the soybeans there. Okay, let's go to our macro calendar. We have a lot going on today. We have a Turkish interest rate decision, no change expected, but there's been talk that they're eventually going to start pulling down that rate, a 24% rate, as the lira has stabilized somewhat. ADP, we never know what to do with that as a preview for the Friday non-farm payrolls. And then I think the two highlights for me are today's Bank of Canada decision. You have the Bank of Canada, actually the market is not even pricing yet that first rate cut for the Bank of Canada. They sort of unwound expectations of further hikes. That's been the first big step. We've seen a weak Canadian dollar, but I think the pivot here risks being a bit more pronounced to the dovish side than the market's expecting, given the very weak GDP prints and softness in the Canadian housing market. So we'll be watching for signal there. We're up into some interesting territory in dollar Canada, having cleared some resistance, and the further resistance is a couple of percent higher. We also have the Fed's Williams. He's the New York Fed's governor, out speaking, and of course also a voter. This could be a rather prominent speech. We're all looking for this big transition in the Fed's thinking as they second guess their quantitative tightening policy, and second guess all of their models and how inflation works in the economy based on employment, Phillips curve, everything else. So this could be very interesting for a signal value from the Fed today. And then we have the ECB meeting tomorrow. You can see that on the overview here. A key one as we're again starting to watch for this pivot towards more dovish policy options. And then I think the key one, sort of bookending all this noise we've had from the Fed turning around, and then a lot of the U.S. data has been rather resilient of late. If we see another high print on the average hourly earnings, the communication message becomes a bit of a challenge in terms of that pivot from the Fed towards a more dovish stance if we're printing new highs for the cycle. Even though it is a lagging indicator, all of these employment and earnings figures, still, it makes it a hard task for them to pivot much more than what the market has already priced in. Hence, the potential for more dollar strength. I think that'll do it for today. We'll be back tomorrow with another edition of the Saxo Bank Morning Call. Thanks for joining.